All right, today we're going to dive into one of the scariest, most confusing things in all of economics. I'm talking about stagflation.
Yeah, you'll often hear it called that. And believe me, it's for a very good reason. It's this bizarre situation that just breaks all the normal rules and traps an entire economy in a really painful cycle.
And this right here is the core puzzle. See, normally you get inflation when the economy is booming, right? Lots of jobs, lots of spending, that's the trade-off. But what on earth happens when you get all the pain of rising prices without any of the gain from a hot economy?
Well, what you get is a situation that chews away at your savings while at the very same time making it tougher to find or even keep a job. It is, no exaggeration, a total economic nightmare.
So let's get into it. What exactly is this nightmare scenario? In this first section, we're going to break down what stagflation actually means and why it gives policymakers such a massive headache.
You know, the name itself really tells you the whole story. It's literally a mashup of two words, stagnation, which just means the economy has stalled out, and inflation, which means prices are shooting up. Put those two together and you get this toxic cocktail of high unemployment and a skyrocketing cost of living. Ouch.
Okay, so this is where it gets really fascinating, because this is where you can see how stagflation just completely tears up the economic rulebook. Think about it. In a normal cycle, if the economy's slow, what does the central bank do? They cut interest rates to get people spending. And if inflation is too high, they raise rates to cool things down. Simple, right? But with stagflation, you've got both problems at once. If you raise rates to fight inflation, you'll make the stagnation even worse. But if you cut rates to boost growth, you'll just pour gasoline on the inflation fire. It's a total policy trap. There's just no easy way out.
To really wrap our heads around this, we have to jump in a time machine. We're going back to the 1970s, which is pretty much the definitive case study. You could call it the original crime scene, where stagflation first went on a rampage through the global economy.
So, what set it all off? It was like a series of 1-2 punches. First, you have the Nixon shock. Back in '71, the U.S. basically announced the dollar wouldn't be backed by gold anymore, and that threw global currencies into chaos. Then, wham, two massive oil shocks hit, and the price of crude oil, which is an ingredient in, well, everything, just went through the roof. So yeah, you can see this wasn't just one single thing. It was a total perfect storm. You had these huge shocks to the world's oil supply hitting at the same time that domestic policies were just pumping more and more money into the system. And what's the result of that? You get way too much money chasing way too few goods.
And the result? It was absolutely staggering. By 1980, the inflation rate in the U.S. hit its peak at nearly 14%. Think about that. That means the cost of just living your life was exploding, just eating away at people's paychecks.
And this brings us to something called the misery index. It's a really simple but powerful idea. You just add the inflation rate and the unemployment rate together. And in the late 70s, it hit an absolutely eye-watering 20%. I mean, that number just perfectly captures the combined economic pain that regular families were going through.
So how did this nightmare finally end? Well, let's just say the cure was almost as painful as the disease itself. Let's take a look at the incredibly dramatic and controversial move that finally broke the back of stagflation.
So in 1979, this new Federal Reserve chairman, a guy named Paul Volcker, came in and decided enough was enough. He took what he himself called draconian measures. And you can see it right here. He jacked up the prime interest rate to an absolutely mind-blowing 21.5%. This wasn't a tweak. This was a deliberate shock to the entire system.
And you know what? The Volcker shock? It worked. But man, it came at a huge cost. It threw the country into a deep, painful recession. Unemployment soared over 10%. But, and this is the crucial part, it finally broke people's expectation that inflation was just going to keep going up forever. It proved that the central bank was serious, and that restored its credibility.
Okay, I know this might all sound like ancient history, right? But the word stagflation is suddenly all over the headlines again. So the big question is, could it actually happen again? Let's take a look at the risks we're facing right now.
So for decades, we had this massive force keeping prices down. Globalization, cheap goods from all over the world. But now, we're seeing a huge shift towards protectionism, bringing manufacturing back home. And here's the thing. Just like those oil embargoes in the 70s were a negative supply shock, today's tariffs and trade barriers can do the exact same thing. They raise the cost of goods and can really fan the flames of inflation.
And when you look at the economic projections for the next couple of years, well, you start to see a pretty worrying pattern.
We're looking at slower growth, inflation that just won't seem to go away, and all sorts of major geopolitical risks bubbling up. That combination, that's exactly the kind of thing that has economists on the edge of their seats.
But there is a potential wild card in all of this, and that's AI. Could a massive productivity boom from artificial intelligence act as a positive supply shock? Could it make our economy so much more efficient that it actually counteracts all these inflationary pressures? Honestly, that is the key debate happening among economists right now.
All right, let's wrap this up by bringing it all back to you. What does all this mean for your wallet, for your investments? How do you even begin to prepare for an environment that completely flips traditional financial wisdom on its head?
Look, at its core, stagflation is just devastating for a family's finances. Your savings are losing value every single day, while your paycheck struggles to keep up with the rising cost of absolute essentials like food and gas. And it really disproportionately hits people living paycheck to paycheck the hardest. And for anyone who invests, this is a massive warning sign. That standard, boilerplate advice, the 60-40 stock and bond portfolio, it can fail spectacularly. Why? Well, think about it. The high interest rates needed to fight inflation absolutely crush bond prices. At the same time, the stagnant economy hammers company profits, hurting stock prices. They can both go down together.
So what does tend to work? Well, historically, investors have flocked to what they call real assets. We're talking about tangible stuff, commodities, gold, things you can actually touch that often go up in price during inflation. Real estate can also be a pretty solid hedge, along with something called TIPS. That stands for Treasury Inflation Protected Securities. They're special government bonds designed specifically to protect your money from being eaten away by inflation. And look, this isn't just some theory. The historical data here really tells the story. You can see plain as day how assets like gold and commodities delivered really strong returns during the last big bout of stagflation, while things like long-term bonds got absolutely decimated. The proof is in the numbers. So we'll leave you with this final thought to chew on. In a world that's loaded with debt, and with new barriers to trade going up all the time, is your financial strategy really prepared for the possible return of the economic nightmare?